Well, hello, Maverick traders. Welcome out to your market roundup for October 4th. Corey here with you, and let's get to it. What a day in the markets. Incredible price action, huge bursting rally, and that inverse cup and handle that I talked about last week is intact. It was in a little bit of jeopardy at the end of last week, but we'll talk about that more as we go. So, as you look at this day's performance, incredible, basically up anywhere from about basically 3% across the board in the Dow, the S&P, Nasdaq, and Russell, with almost 4% upside. Oil up 3, gold up 2. That's a huge move in precious metals. And as you look at the price patterns again, we'll talk about these inverse cup and handles. The Qs and the S&P still have those patterns, and the heat map about as green as you can ever see it. Advancers versus decliners, almost 9-1 stocks going up. And when markets move in a big way, up or down, the correlations go to 1, meaning everything moves. On Friday of last week, most everything was down. On Tuesday, today of this week, everything was up, and so it's just bright green. The 50-period moving average has seen some improvement since last week, so 22% of stocks above the 50 MA. Today's news, stock surge. This is the best two-day rally that we've seen in over 2 years. Now, you might think, well, that's a very good sign for the markets. That's very bullish. Well, it can lead to more upside in the short term, but it actually speaks to an unhealthy market. Remember that it's within bear markets that you see the most violent, vicious rallies. If you go back to history and you look at the biggest up days, they're a who's who of bear markets, right? You'll see some of the biggest up days in 2008 in the global financial crisis, in 2020 at the COVID shutdown, in 2000 in the tech bubble burst, and so forth, even all the way back to the Great Depression that happened in the 30s. So you'll see that the biggest rallies are kind of a sign of an unhealthy market. So yeah, it's bullish in the short run, huge move, and I tweeted about this. I'm not a huge Twitter guy. We'll talk more about Twitter here in a second, but I tweeted about this yesterday, that I still suspected a big rally, and sure enough, today came through in flying colors. Elon Musk agrees to buy Twitter at the agreed upon original buyout price. I think it was getting down to the end, and he basically knew it was going to cost a lot of lawyer fees. He was going to end up paying that price anyway, and it would look bad in that he would lose the lawsuit, et cetera, et cetera. He said, I'm going to end up with this anyway. Let's just take it on right here and save some money and save some trouble. So let's take a look at these charts. The S&P chart really kind of has some normalcy to it. I mentioned this last week, that I wouldn't be surprised to kind of see a squish down. I used to think this 20 years ago when I first started studying technical analysis. I kind of thought of support and resistance as this rigid, strong, almost cement line. Like if you go below that, well, all deals off. And now, for the last 15 years or so, I teach it that it's a cushion, it's a mattress. You usually squish into and then bounce. It's almost like a trampoline. You hit it and it squishes down, and then it springs you upward. And part of the reason for that, if you really think about how much selling pressure there was pushing stocks down throughout here, that's a lot of supply. That's a ton of selling pressure. And at a certain point, sellers will just run out of steam, right? There's anyone that's willing to sell will give up and sell and throw in the towel, and there just won't be sellers left. And that's what a capitulation is. It's just kind of throwing your hands up in the air and saying enough's enough. And usually where capitulation happens in this type of dynamic is as you squish into support. This is where people panic, and they think support is some rigid line, right? And this is what we call a bear trap as well. Anyone that tried to short the market thinking, oh, support's breaking and so on, not really, but they got trapped, and they got trapped as soon as Monday. On Monday, we rallied back all of Friday's decline and then some, and that was just a punctuation mark. Like, the bulls just gained control. Essentially, we've held support. Don't worry about the fact that it traded below it for that day. In my opinion, in my estimation, I like those kind of, it's almost like a false move. It's just this 1 day push. You'll see the same thing at big uptrends, like in resistance. Imagine that you get up to this level. This level stands out, right? What would tend to happen is, let's say that you exhaust a ton of buying. You rally and you consolidate, and let's say that it's just running higher coming up to this for one reason or another. Even if it pierces through for a day, it's probably running out of gas. You've expended so much energy just to get here. You've expended so much buying power just to get to that level that this is much more of a take profit signal than a, hey, hurry and buy, we're going to keep running higher, right? I wouldn't trust that as a breakout. I would say, well, we're probably squishing into that mattress and it's probably going to come springing right back, and this will be kind of a bull trap, anyone that jumped in there. And that's what I see this as. It's a bear trap. And I talked about this last week, that I think what the big picture chart is this. I think we're in this big inverse cup and handle, and last week's price action doesn't deter me. Of course, on Friday, like everyone else, I said, oh, this wasn't a great finish. We finished on the lows. Monday was going to be make or break. Monday was the savior for this market because we easily could have come in on Monday and had another, gap down, further selling, and hey, support is breaking, right? It was possible. I didn't think that was how this market was going to behave, but I'm not right every time. So, anything was possible around those levels, but that's where you've got to be quick to react and quick to shift, I think. I wasn't mega bullish on Friday. I became much more bullish and confident on Monday when we recovered all of that. And I said, hey, we squished into that support, but I suspect that is a trampoline and we are going to spring out of that. So that's kind of what I was talking about in terms of my tweet. The NASDAQ really didn't even pierce much. It just peeked its head down below there, but basically springing up, and the same type of thing, creating a little handle effect, a rally effect. Now, up 3% today, could you kind of be choppy a little bit for a day or two? Yeah, but I still think there's upside. I still think there's a little bit more push to the upside overall. Now, I don't think on a day like today the heat map is overly helpful. Maybe kind of look through it for anything that's red and say, well, why was this such an underperformer? But in essence, everything was somewhat heavily correlated, and anything that was in red probably just had a news story today that really pushed it down much more than anything else. So my guess is that this company just had some company specific news that pushed it down, and that doesn't necessarily mean it's going to lead to more selling pressure. So I kind of, on days like this, almost throw out the heat map and say, okay, everything's green except for those things that had company specific news, and let's just look at some charts and find a good setup. So as quick as Monday, I mean, I tweeted about it. Look, I went from thinking this market could be in trouble on Friday to thinking this market's in pretty darn good shape here with that fake out move. So I would say my weekly outlook personally certainly shifted, and shifted in a big way. Let's take a look at a few trades here. So some ideas. We highlighted Pinduoduo last week and kind of talked about it has that kind of cup and handle effect. This pullback down here, still above its 50-period moving average. I think first stop is a retest back up to here and probably up and through. Not unlike what we just talked about. See how this initially kind of pierced through, but then fell back in, kind of squished into that level and then fell back. I think the third time up and through this level should be the charm. So pretty good looking chart there. Also like Pinterest, still managing to trend higher over the past couple of months in what's been a really tough market environment. Think about how strong you have to be to be going up the past few weeks when the market's just free falling to the downside. So really good price action. And here I think you can kind of play the channel, forecast a little channel line off the peaks here, and that projects up to about 27 right now per share. And then TTD, this is Trade Desk. We talked about this one as it was coming down here, and I don't remember exactly where, but I kind of talked about playing it. It was not a good play wherever it was back in here. It bounced temporarily, but then has obviously sunk in. I still think it's a good play, big picture, you know, if you have a little bit longer time frame. So my trade that I put on was a little bit longer term trade because I thought we could get a bigger upside move. I'm probably out of the money at this point on my target, but I'm considering new positions as if I don't have a trade, that sort of thing. But I suspect this is going to work its way back up towards 75. On the bearish side, AMC, GME, GameStop, these types of meme stocks, I'd be surprised if they just run away with things here. So any type of bounces, I've been mentioning these for the past few weeks. Rallies are to be shorted, to be bearish on. I've had positions in them. I've had puts on GME, etc. Well, I think this is just another bounce and another opportunity to get short here in this bounce. So look for levels, look for areas, look for risk to reward that you can put a trade around. Still suspect that this thing's trading lower, and you know, not a bad price target to expect a push down there towards 6 at least. From its current $8 per share, that's a 25% drop. So pretty good size move that it would take to get down there, and it could get there in relatively quick order. And then the last two bearish ideas are kind of correlated, CrowdStrike and Palo Alto Networks. They're both kind of internet security type of plays. CrowdStrike, I think, is kind of a broken trend line retest underneath the trend line type of idea. I sort of like the CrowdStrike CRWD chart better. It just is a little bit weaker, a little bit more bearish, filled the gap here. I suspect CrowdStrike should have another leg to the downside. And then Palo Alto, the only reason I kind of prefer CrowdStrike, it's similar. You have the trend line in effect, the broken trend line, and it's kind of kissing underneath of that trend line, if you will, which is kind of what a head and shoulders top sort of looks like. Is you basically have a broken trend line that gets tested underneath, right? So you're kind of making higher levels, and then you break down and you make a lower level over here. I sort of prefer CrowdStrike only because it's a little bit weaker. If this goes up for another day or so, I probably won't pull the trigger on Palo Alto, but I might still enter into a bearish trade on CrowdStrike. I still think, regardless of how they trade for the next day or two, that each of those are going to go down and challenge some lower prices. And in the case of Palo Alto, maybe 155-ish is being kind of a price target. Again, pretty good downsized target, almost 20 points per share. So plenty of meat on the bone there if these underperform, and they just look like they're poised to do that. So market outlook, big picture, yes, we're still in a bear market. Short term, I think it's an inverse cup and handle. Now the inverse cup and handle only prices out to 38.50 on the upside, and guess what? With the last 2 days rally, we've already gone to 37.90. So my target that I've been talking about for a couple hundred points for about a 5.5 to 6% upside rally, it's almost already done that. It's only 60 points away. So of the 200 and some odd points, it's already gone 80% of that or what have you. So we're almost there. Could we go higher than 38.50? Yes. Maybe it's not going to be an inverse cup and handle and so on, but I wouldn't get too optimistic here in terms of the upside. It's at minimum going to be a little choppy. I actually used this rally today to take off a couple of bullish positions. Just things that I felt like were kind of underperforming but had some nice profit in them. And I may take off some others. I have structured my portfolio bullish, which felt a little painful on Friday, I have to say. I thought this week might turn into me licking wounds and closing positions and mea culpa saying, well, I was wrong, it didn't bounce, and so forth. It did finally do that and did kind of recover, so I'm in pretty good shape here. But that's the thing about markets. You can never be 100% on everything you do. You just try to get more things right and have good risk management. So Friday, we've got payrolls. There were some important changes that have taken place over the past week. Huge changes. The Bank of England went from quantitative tightening to quantitative easing. They initiated a new bond buying program. Australia, the RBA, was expected to raise rates by 50 basis points. They only raised rates by 30 basis points. That's essentially them moving to a, I wouldn't call it QE, I guess, but at least dovish. At least them saying we need to quit pushing the brake too hard. We're going to create crashes and so on. We need to ease into this thing. And so these are some bullish turns that central banks are doing. Now, people are probably expecting a Fed pivot, and part of this rally is predicated on that. And I don't think the Fed's ready to pivot dramatically. Could they slow things down? Could they kind of say, hey, we don't need to keep raising rates at the same pace? Could they kind of push off of the brake? They're pushing the brake so hard. Could they kind of ease up? Yes, but they're not about to initiate a new bond buying program and start cutting rates or anything like that. So be realistic about it. International markets are in a much tougher spot. That the Bank of England or Europe, the ECB, I mean, for those central banks to ease and to go a little bit more here, look, they're in a worse spot. They've got economic conditions that are really rough. They've got oil problems, energy crisis. They've got a lot of issues to deal with. The U.S. doesn't have. The U.S. has some advantages. It's the U.S. dollar is the reserve currency of the world. We've got the largest economy. We've got the largest military. We've got the largest of so many different things in terms of commerce and such. So we're in a little bit better spot than international markets, and we're going to be less likely to start easing and doing some of those things in any short period of time. So earnings reports, not much happening there. Tilray, Conagra, but basically we've passed earnings season. So stay tuned for more opportunities, but it's been a huge rally the last 2 days, a nice big rally here, and we're getting close to the price targets that I had set for this short-term rally. Have a great rest of your day, a great week ahead, and we will see you next time. Goodbye, everyone.